Hello and welcome to BloombergQuint. We're in conversation with Dr. V. Anantha Nageswaran, Chief Economic Advisor to the Government of India. So thank you very much for sitting down with us.
You're welcome, Ira.
Lots of questions, but
Sure,
I'll start with the big picture. I think the big story top of mind of everybody is what has happened in the last month or so in terms of oil prices. Big change for India, growth, inflation, current account implications. Let me first ask you for your broad analysis on how you are assessing how things have changed.
I mean, that's a fair question. It must be on everybody's top of their minds. Last time when I talked with someone in the media, I did mention that the impact obviously would depend not only on the level of the oil price, but its persistence. So we must remember that the new financial year hasn't yet started. So it may be possible that after a few weeks, oil prices do settle down at a range which is comfortable or tolerable for us. So that's a possibility which we cannot exclude. But should the current state of supply scarcity and constraints persist well into the new financial year, then I think the range of implications we need to think about is, number one, for example, if a commodity were to become supply constrained, do we want the prices to reflect its relative scarcity or make it lower from the point of view of its impact on disposable income and purchasing power? So there are two considerations there. The third consideration is, of course, the energy transition, focus on renewable energy, because this would also force higher blending of ethanol, which is a good thing. And of course, then there is a fiscal consequence if you lower the duties, because as you know, just a couple of days ago, the government did announce that the Garib Kalyan Yojana would be extended for 6 more months, and that is on a 6-monthly basis, it's about 80,000 crores. So annualized, it's 1.6 lakh crores. So these are all the multiple considerations. I can fully understand that different people would attach different weights to these considerations. So I would still think that we need to wait and see in the new financial year the persistence of the high oil price before the government thinks in terms of fiscal adjustments and balancing them out with price pass-through.
Okay, understood. Let me pick on that first part, which essentially is burden sharing to some extent, right?
Yeah, exactly.
Now, there, I think one consideration is that at this point in time, when inflation is already on the higher side, if you take into account our current comfort band, and you come out of a pandemic where incomes would have probably not completely been restored to pre-pandemic levels. At this stage, do you want to add that burden on consumption? Fine.
I mean, that's one way of looking at it, for sure. The other way of looking at it is, suppose the government does provide, let's say, hypothetically, duty relief in order to not fully offset, but at least partially absorb the price increase on the raw material cost. And if in the process government's borrowing rises, and then if therefore the bond market reflects that gets passed on to everybody, not just the oil users. The higher, because the government cost of capital is the benchmark. So that also is another layer of cost on the entire economy. So you have these multiple considerations. As I said, I can fully understand different people attach different weights to these considerations. Therefore, the final decision would actually depend on which of these factors would impinge on the economy more than the other or less than the other, and that would dictate the course of action. And there, I think it is possible the judgments can differ.
Understood. No, and that's fair. You talked about the fact that it's important to see the persistence. Actually, when this whole crisis started, most people assumed that a war of this nature probably won't last beyond days or weeks. We're already a month into this. At what stage does a decision become imminent?
No, that's difficult to say. I mean, I would personally think that if it lasted less than a quarter into the new financial year, it shouldn't have a lasting impact. For example, even 2 weeks ago, the prices dropped suddenly from 130 to 100 and then spiked to 120. And then after the news of Shanghai lockdown, it came down yesterday by another $10. It's incredibly volatile. Therefore, in this volatile situation, to make a policy decision that may or may not be reversible later is not the most advisable thing to do.
Sure. So on the other two sort of sides of it, the growth impact, but also the current account impact, how do you analyze that? One way or policy choices could probably shift between a currency adjustment, allowing for some rebalancing of the current account deficit widening. Alternatively, tighter fiscal and monetary policy you being used?
Yeah, I mean, look, if when you have a supply shock on the raw material, if you respond to them with a very tight combined fiscal and monetary policy, it's obviously going to have a big impact on growth. So you must let the currency take some of the adjustment. And I think our current account deficit, obviously, it will widen. And but because of the inherent uncertainty in making assumptions on the level and the duration of the oil price increase, it is difficult to say the extent of deterioration in the current account balance that we would face. But based on some assumptions about 100, 110, 120, I still think that the market's appetite for funding Indian current account deficit would remain relatively good. And if the current account deficit widens to somewhere between 2.5 to 2.8% of GDP, let's say, I mean, from where we are at this financial year end, which could be around 1.5, 1.6%, I still think on balance, it would be a manageable situation.
Okay. Will you share your calculus with us on scenarios? Say $100 per barrel oil for the rest of the fiscal year?
I think I would say, in general, if you have a persistence of oil price at $110 or above, then that would require some sort of a reaction, a burden sharing decision between the oil marketing companies, between the government, and between the consumer, etc. But if it is going to be 100 or below, I think it is manageable without upsetting the current arrangement.
Okay, understood. Let me shift a little bit towards the sort of underlying economic conditions, particularly on the consumption side. What is your assessment based on the data that you've seen as to what is the strength of consumption in the Indian economy?
Look, I mean, the more than many of the high frequency indicators, I do take a look at the RBI's forward-looking surveys that they come up with before their monetary policy meeting, and there the picture is clearly subdued. And in fact, I was just going through the business expectations of inflation, which IIM Ahmedabad has been producing, and there, if you look at the corporate sector's feedback, they do say that demand is subdued, and of course, this reflects January information, and you are seeing in February and March, if you look at the airports, they are quite busy and traffic is quite brisk. So, however, before we could all breathe a sigh of relief about Omicron having been somewhat mild, then this big shock had come about, the oil price shock, etc. So my feeling is that the first half of the next financial year would still see subdued consumption growth, because there will be at the back of the people's minds the fear of a recurrence of the pandemic because of what is going on elsewhere in the world. Will we get another wave or another variant? So I think until the cloud of the pandemic lifts over our heads, I think consumption recovery would remain restrained, and that would in turn have knock-on effects of the timing of the capital expenditure expansion plans by the private sector.
I'll get to that in a minute. There is then a concern that so if consumption is weak, private investment at current capacity utilization levels will probably not pick up. There is the government spending, of course, that's coming up, which will hopefully spur some activity. Exports was supposed to be a lever. I don't know how it plays out now. Could we hit into stagflationary-like conditions? I know India will never see stagflation in the Western
exactly, because
context.
I think different people have different personal understanding of the
I know,
exactly. Stagflation. No, you are right. See, government capex, as we all know, have been widely discussed since the budget was tabled, is definitely doing the role it is supposed to be doing, which is to sort of keep the underlying investments going and creating the basic platform on which private capex can take over. I just want to highlight one point about your comment about the capacity utilization. That is true. On average, capacity utilization levels are not at a point where they would require additional capacities. I agree with that. But if you really look at the top 4 companies in different sectors, their capacity utilization levels are much higher. Sector as a whole, and both steel, cement, I forget the other two, definitely steel and cement and some chemical industries, I noticed that the capex capacity utilization of the top enterprises are above 75 to 80%. And that is what we saw. I mean, from your BloombergQuint itself, I saw many of the capital goods equipment companies are witnessing very brisk offtake in their orders, etc. That's a very strong indirect indicator that some companies are looking to expand capacity, notwithstanding the average numbers. But I think the truth is, yes, you have to wait for at least a quarter or two before private sector really begins to invest. And the exports, you are right, it all depends on the global economy and the demand that is coming from there. So we had a great run in 21-22, but that's a great silver lining. However, I agree that uncertainties have increased. So the question is, are we going to have a stagflation light, as you put it? I think, stagnation in the growth rate at what level is the question mark. I mean, most people assume that stagflation means economic stagnation plus high inflation, and which means the economy comes to a sort of a standstill. Growth rate doesn't pick up, the economy stands still. That is a stagflation. So in our case, it is not about stagnation at all, because growth will be happening. There is going to be a positive delta. The question is whether it is the 8.9 or 9%.
How far below potential it is.
How far below the potential, of course, is another gray area.
Yes, I
mean, potential could be anywhere between 6 and 7%, and it could even pick up to 8% few years down the road. But right now, you could say potential is 6 to 7. Private sector forecasts are coming down from double-digit levels down to 8 and 9. Somebody even coming up at 7.5 and so on. So it's right now, it's very difficult to sort of put a precise number and say, this is the range within which the GDP growth would converge for 22-23. I would at the moment think that 6.5 to 7 or 6.5 to 7.5 still looks, in terms of real GDP growth,
Annual.
Is still feasible for the year 22-23.
Okay.
And the budget itself assumed the nominal GDP growth of only about 11.1%, which gives a very good buffer. And if, as we discussed earlier in the conversation, if the oil price elevated levels do not last for too long, I think those assumptions would hold.
What is your perspective on inflation?
Obviously, the numbers will be anywhere between 5 and 6, depending on the extent of, again, the same answer, pass through, the persistence of the oil price and the pass through, etc. So I think, yeah, we are going to be sort of flirting with the upper end of the range of 2 to 6%. And it's not only oil, we also have to watch out for food prices, etc. So it is going to be a challenge managing inflation and the growth concerns that we have. So,
but we won't send a message that we are easing up on our very recent inflation focus if we don't act when we are closer to the upper band.
Well, I think that is a decision for the RBI to make. I don't want to comment on that.
Sir, in a blue sky scenario, and we've talked about a lot of the risk, I think what was happening at the beginning of this year was that it was finally clear that the twill balance sheet problem is out of our system broadly, right? Mm-hmm. Large corporates had deleveraged, banks were cleaner.
Yeah.
So potentially, if this government CAPEX play goes as planned, we could get a solid investment cycle?
I think so, because we did all the hard work in the last decade. I mean, the first decade was a CAPEX and lending boom. Second decade was retrenchment and reversion to the mean. And the third decade should have seen a sort of a recovery. But then came the pandemic, and then now the new uncertainties, etc. But hopefully, I mean, if we talk of a decade, you still have about 8 years to go. I think if these conditions do settle, I do expect a private sector investment recovery, as well as bank credit growth rate to recover as well. So that is why I am quite clear in my mind that, notwithstanding the current uncertainties we are facing, our economic glass is more than half full.
The issue here again is only of timing, perhaps. And,
yes, I agree with you. I'll concede that the timing has become more rather than less uncertain in the last several weeks. But I still think, we are talking about a decade, that is 8 years away, 8 years out. There is still room for the current set of concerns to recede.
We have to get the CAPEX play right, both from the central government and the state government. And I'll just add a subsidiary question. So, obviously, central government CAPEX this time was very large, especially if you compare it to pre-pandemic times. If you look at state budgets, all of them are giving you very high numbers of CAPEX. I'm just wondering, sort of state capacity to actually push that kind of spending through.
Well, I think it's difficult for me to, in this short format to discuss state capacity, which is sort of
Yes, I know.
which is an enduring issue. But at the same time, we have to look at the track record in the last several years. Union government's actual capital expenditure has been rising quite impressively. So I wouldn't discount the possibility that we are able to either achieve the full extent of 7.5 lakh crores of the CAPEX, which includes 1 lakh crores of interest-free loan to states. So I wouldn't rule it out. And also, in fact, if you look at the monthly RBI's State of the Economy chapter in the monthly bulletins, it is good to note that state governments in the first 10 months data that we have also upped their actual capital expenditure quite a bit. I know it's a depressed
60% of their budgets, I think.
No, also the growth rate over the previous year.
Growth rates, yes.
I think the growth rate is quite impressive. Of course, you would say that the previous year's base was a bit depressed, but nonetheless, that's an encouraging sign. And I think, notwithstanding all the known issues of state capacity, etc., the intent would definitely translate into some reasonable delta. Whether the delta is as big as it is budgeted, that we will only know with the benefit of hindsight. But I am confident that the delta in terms of CAPEX spending would be quite reasonable, both from the union and the state governments.
Are you fearing uncertainty on state finances this year? We've got the GST compensation decision. I'm saying decision coming up because we don't know which way it's going as to whether
I think it's a bit too premature to comment.
June. It's coming up in June.
Yeah, I mean, well, as we have been discussing, there have been so many proximate fires that we are fighting. Even June, in the way the world is evolving, even June looks like a long term.
But are you sort of at least keeping an eye out on state finances? Because I think we've all come to realize that growth for the economy is center plus state.
I mean, it's a given, and we all know that in the last, despite the pandemic, the average levels of GST collections have been picking up. So for a long time, we were wondering about the 1 lakh crores as the sort of the threshold. Now it is 1.2 or 1.3 lakh crores. So I'm sure there will be concentration of minds on the issue as we approach the deadline that you mentioned, and by then, if the uncertainties have faded, then there would be a different mindset to look at the problem.
So I want to just go back to the global picture very briefly. You've seen perhaps the steepest tightening cycle from the Fed in a very long time. We're talking about 150 basis points. Some people saying 200.
Announced cycle.
Announced cycle, yes. Yeah. It's difficult to, markets seem very sanguine, relatively speaking. It's difficult to understand whether such tightening would go by with calm in the markets. And
so obviously then it shows that the market doesn't believe that the Fed would be able to walk its talk on the extent of tightening that they have penned in their projections. But nonetheless, I agree with you that the market's relative resilience in the US and elsewhere is a sort of a puzzle. I have my doubts because of the underlying, stock of debt that these economies carry and the combined stagflationary conditions. Although I took note of the fact that that Federal Reserve Chairman did say that he would look through supply, sort of the supply impact and focus on inflation management. We will see if they do indeed sort of go through with their planned rate hikes all the way into 2023. That would definitely have an impact on global risk appetite, stock market levels, capital flows into emerging economies, etc. But I have my doubts whether the economic conditions would evolve in such a way that the Fed would be able to carry out its intended rate hikes to the fullest extent that they have told us that they would do so.
Do you think they'll buckle like they have every time there's...
the
only difference now is that inflation is at 8%. I said the only difference is that inflation at 8%, they may not have the opportunity to buckle.
I wouldn't use the word buckle because obviously all of us have to update our plans based on how the reality evolves. And like we discussed in the case of the crude oil price and the oil price in India, it's a question of what weights you assign to different priorities. And we all know that real life is all about trade-offs. So I think what trade-off that they would consider down the road and which one they would prioritize can change. And that is the reason why I feel they may not be able to or willing to carry out the full extent of rate hikes that they have told us they would do so.
What does India need to be mindful of? I know the comparisons to 2013 and now are much, much more favorable now.
Yeah.
Are we in a position where, we are perhaps able to run a slightly higher current account deficit without a very disruptive turn on the currency markets or otherwise?
I think again, on balance, my answer is yes. We should be able to manage, because should an unpleasant scenario with respect to oil price persistence happen for the year 22-23, then we have to remember that it is a shock that will affect the entire world. And we all know about the vulnerabilities in Europe. Then we have the vulnerabilities of some other emerging economies with respect to food prices, etc. So then what will happen is investors and the market would start to look at relative fundamentals more closely. And there again, I think India stands in good stead. So that sort of gives me the confidence that yes, definitely compared to 2 months ago, or in, let's say, 4 months ago before Omicron, the way we were looking at things, and then we had some relief with the Omicron being somewhat milder, and then suddenly before we could sort of start to line up at the start line for a sprint, then this situation has arisen. But I still think India should be able to weather the storm and the situation better than other emerging economies or even developed economies.
Last question then, sir. Issues that you think need attention, policy attention. We didn't get time to speak about the employment side or the job side, either that or others that you think need concentrated policy attention at this stage.
So, I mean, whether it is the employment situation or women's labor force participation rate in the economy or the MSME sector, yes, all have been receiving attention. And you have seen the actions taken in the budget with respect to extending the emergency credit line guarantee scheme, and now the extension of the Garib Kalyan Yojana for 6 months, and also the additional capitalization of CGT MSC so that it could underwrite more loans, etc. So there are multiple. So there is complete cognizance and acceptance of the importance of these challenges, and that is why the actions have been taken and will continue to be taken. But obviously, when fresh uncertainties arise, they do sort of delay the progress which we can see in the data. So that is happening. But the cognizance of the issues and therefore the need to address them, and actual decisions have been taken to address them. It is a bit unfortunate, but because of external developments, the time in which we can see the impact, that gets pushed out.
Thank you so much, Dr. Nageswaran, for taking the time to speak to us.
Good to speak to you.
Thanks for watching BloombergQuint.